wasn't mentioned in the CVs up there for Robert Shiller is he's just won the Nobel Prize for Economics. And I think we should start. Thank you very much, and well-deserved, I think, having read your work for a long time. So let's start off as you are the bubble man, really, in the public mind and in the financial markets mind. But how you define bubbles, how they develop, and how you recognize them.
Well, my Nobel Prize winner, Eugene Fama, says that the profession has no definition of a bubble, and that he attributes the term bubble to the news media.
Including the Economist.
And everything is a bubble. That's Fama's assertion. Well, he's correct about the origin. Actually, the word bubble doesn't... There was an earlier word called windhandel in Dutch, wind trade, and it's kind of a bubbly sounding word, referring to the kind of speculation that was going on in the tulip mania in the 1630s. So the dictionary says the bubble in this context means some speculative asset prices that is filled with air and is incorrect. So it sounds like it's mispricing. But I don't think that captures what we mean by bubble. And in fact, when I wrote the second edition to my book, Irrational Exuberance, I thought I had to actually define it. What do we mean by a bubble? And I actually found that it was difficult to define in a few words. But the essential item is that I would say it's a price-mediated feedback, that people are observing prices going up, and it's bringing attention. It's bringing people in who weren't paying attention before, millions of people, and then they amplify the feedback for a while by buying into it. Eventually, however, the price gets ridiculously high, and people like Economist magazine start pointing out the folly of it, and then it suddenly turns and bursts.
Is there a mathematical definition? I mean,
but that's
GLO.
not a complete definition.
No,
I think it's a whole phenomenon that it's like a mental illness, but it's a social mental illness. It's something that appears from time to time, and it's marked by excessive enthusiasm, participation of the news media, feelings of regret among people who weren't in the bubble, inadequacy, feelings of envy for others, feelings of meaninglessness in my work. And then as the bubble progresses, I'm talking like a psychologist. My wife is a psychologist, but I think bubble is a psychoeconomic phenomenon. But it also even gets involved in people's views of themselves and their identity in a really big bubble, that they start to think differently, that I used to be ignorant, but I've discovered my investor self. And now I pride myself on knowing things about investing and reading newspapers and magazines. So it becomes really ingrained in a culture. And then when it finally bursts, it's devastating for some people because it rips out their self-esteem. And then you go through a period of a negative bubble. That's...
Yes.
See, it's a list of symptoms of a bubble, which may appear differently in different circumstances.
I think on the psychology point, I think it was J.K. Galbraith said there's nothing more upsetting than seeing a friend or neighbor getting rich.
Right.
You follow that. Do you accept the sort of Kindleberger process whereby first you get the displacement, so some new development, new technology like the internet, then you get credit growth, then you get this period of over-trading or the feedback that you're talking about? Does that seem a way of analyzing the build-up of these things that makes sense to you?
By the way, I was Kindleberger's student, so maybe I got this from him. But when I was studying under him, this was considered offbeat. His book, Panics, Crises, and Manias, or something like that, was his vacation work. That's not his serious academic work. It used to be disreputable to mention bubbles, and it's come around. I don't know why. Why is it disreputable? Because the newspapers do it. Because it's a popular thing. It's like hypnosis used to be disreputable for psychologists to study. Eventually, when it's in your face, then we start to think, well, maybe we should. They're starting to put it in textbooks now.
I want to bring in Lewis in a second, but just in terms of there's laws of supply and demand, in terms of other goods, if the price goes up, people want less of it. So what is it about financial assets that means when the price goes up, people want more of it?
That's the central problem with applied finance is how expectations are formed. There was this big revolution in finance and in economics referring to rational expectations. And they realized, well, in fact, it goes back to Keynes in his general theory, 1936. He has a whole chapter on the state of long-term expectations. This was a Keynesian point, that people's behavior depends not on what they think is going to happen next year, but what they think is going to happen in 10 or 20 years. You're planning a business, right? You care about the long term. And that remains forever fuzzy. There's no way to predict that. This is Keynes' emphasized point. And so bubbles are related to that, to the long-term expectations. And they're the expectations that you can't pin down quantitatively.
Yeah. Lewis, you've seen several bubbles. Do you accept Robert's description, definition, or do you think people talk too often about bubbles?
No, I very much accept it. I mean, it's hard not to see it, and I'll just give you a practical view of it as an economist working on Wall Street, which is the economic models that we have to tie down the fundamentals, to be perfectly frank, aren't all that good. And they leave a lot of room for error and whatnot. And so a lot of what we're sort of dealing with on a day-to-day basis is an awful lot of what drives financial markets and their daily fluctuations cannot easily be defined by the fundamentals. That's another aspect of Professor Shiller's work. But what that means is you can get on these paths where asset prices diverge from the fundamentals. And my ability as an economist to come in and present evidence that I think is related to the fundamentals to disrupt that is limited by, to be perfectly frank, the inaccuracy of the models we have. And so the ability of the economics to kind of tie these things down is not what you would like it to be. And so we deal with this pervasively. I mean, Professor Shiller wrote about sort of excess volatility, and I kind of live in that world where I'm trying to present the fundamentals in a world where an awful lot of the day-to-day variance of markets is driven by other things, frankly.
And is enough work done on this? I mean, we've just been through a series of bubbles, and we're clearing up the aftermath of that. I mean, shouldn't we be working on defining what they are? I mean, Jeremy Grantham at GMO has the 2 standard deviation definition. So if valuations are 2 standard deviations above the average, that's what he regards as a bubble. Is that the sort of thing we should be looking at?
So I want to make one point here, which is there's an important distinction in my mind between bubbles and systemic risk. So I think from a policy perspective, one of the things we care about are the kinds of disruptions we experienced in 2008 and 2009. It's obviously very costly, want to avoid those. The point I would make is those things are related to bubbles, but there are many bubbles that don't generate systemic crises. And you have to think about those things differently. I think we can learn a lot by looking at the history. Those things are related to the credit part of the Kindleberger story you have, but not all bubbles generate that. I would argue, for example, the NASDAQ stock bubble did not generate systemic risk. And in part because while it was a bubble in asset prices, it did not have the credit component that made the system overall vulnerable. I think there are ways of thinking about that distinction that are useful and important. And I think that really kind of has to be the focus.
But is it the response, Professor Shiller? I mean, you wrote about the dot-com bubble and the housing bubble, which you correctly called both of those. But many people think that when the dot-com bubble burst, the Fed then followed subsequently with an easing of interest rates, and that provided the fuel for the housing bubble to inflate again. And so central banks we've got Alan Greenspan on later, but central banks bear a large responsibility for this in that they intervened to support markets when they fell in the last 30 years, but very rarely did anything about markets when they were rising. So this was sort of asymmetric ignorance, it's been called, where they profess not to know when bubbles are being inflated, but they know when they've burst. Is that an analysis you accept?
Yeah, I think the Fed has only partial responsibility for this bubble. If you look at a plot of home prices, they started up in 1997. Nice sigmoid. It's not like the stock market. It grows, rapid growth around 2004. Then it sags. If you look at interest rates, they were a jagged path through that, and it wasn't. It's not one-to-one at all. So I think the bubble kind of had its own life But the Fed certainly didn't help by cutting interest rates right in the midst of the massive bubble. Now, I think that part of what happened was that we had this revolution in economic thinking called the rational expectations revolution, for which Nobel Prizes were awarded in the past, which led to a view of the markets and the efficient markets theory that Eugene Fama named. That theory led to a sense that the central bank ought to just completely leave hands-off financial markets. So it led to a sense of complacency, which is not Greenspan's fault. It's the world he lived, the intellectual world he lived in.
But Lewis, you were involved. Were they really hands-off? Because take 1987, the stock market crashed, or take 1998, LTCM went into difficulty, and rates were cut. So that wasn't hands-off. That was the markets have fallen, help.
I think it's crucial to remember there isn't just one tool, right? We try and put all this discussion about monetary policy. It's important to remember there's prudential regulation in all its forms. And in some sense, I think you have to think of, with respect to the systemic risk aspect of these things, prudential regulation is always going to be the first line of defense. And the question is going to be, what are those extreme circumstances when monetary policy has to address something that prudential regulation can't? I would argue in the years before the crisis, there was a buildup of liquidity in the system. And I would make an argument that from like 2004 to 2006, they hiked rates too slowly, that was a period when the shadow banking system and all of that was sort of building up. That was a time when you could argue that they should have used monetary policy to address a systemic risk issue. But on a lot of these things, you have to ask the first question. The primary mistakes, I would argue, were on the prudential side. Even in the housing story, I would argue the fact that they didn't do as much about the deterioration in underwriting standards and the way that was sort of contributing to this was the first mistake. And monetary policy, I think, is a sort of a separate issue. I think we put too much emphasis on that.
But so what should they have done? I mean, you could do loan-to-value ratios on housing, for example, insist a minimum loan-to-value ratio. If you go back to the 1920s, a lot of people were buying stocks on margin. You could have bit down on that, and there may have been some of that you could have done in the late 1990s as well. But of course, at the same time as they had the general philosophy that markets found their own price, they also had a general philosophy that the financial system knew what it was doing and that it had diversified risk very well, and that you shouldn't be interfering in those relationships either.
Look, I think specifically in what happened to the mortgage space in the run-up to the crisis, there was clear evidence of a deterioration in underwriting standards. There was clear evidence that the way that risk was being distributed was not fully understood through the system. And I think it was a regulatory failure that they didn't take those clear evidence of smoke more seriously. And I agree with you. It's in some sense reflected a broad degree of confidence that financial markets would not do that. But that's the primary mistake, it seems to me, not a monetary policy mistake.
Now, Professor Shiller, I mean, we must remember that bubbles don't just happen in the US. So there have been bubbles in British housing, Spanish housing, Irish housing in the last 10 years. In his book, Alan Greenspan blames Fannie Mae and Freddie Mac for a lot of the US housing bubble, but there were no equivalents of those two in Britain, Ireland, and Spain. So is there something about those examples that pertains, do you think, to the general phenomenon of bubbles?
Well, I think in the last year, we hear talk that there's a going-on bubble in China, Taiwan, Hong Kong, India, Belgium, Norway, UK. I'm just talking the last year. Brazil, Colombia, US, Canada, they're all over. And this can't all be explained by, certainly not, we tend to focus too much on the central bank.
But, do you accept that there are some of these bubbles are real?
Well, that's an interesting thing. I was down in Brazil a couple of months ago, and I see what's going on there as an outsider, and I'm not, I had to decide whether I'm going to say the word bubble. I was speaking to a large audience in Sao Paulo, and I thought maybe I should. At least I don't know that Brazil is in a housing bubble now, but it looks and feels like it right now. The funny thing that's happening in Brazil, when I was there 5 years ago, they told me, we don't have any home price indices. Now they've got one. It's the FIPE ZAP index. They've only had it for a couple years. It goes back only 5 years, but it's recording a doubling of real inflation-corrected home prices in Sao Paulo and Rio. And so I asked them, why is it doubling in 5 years? And they gave me these stories about, well, we now have a better mortgage market. The economy is emerging, and we have a middle class that's forming. All these kind of superficially plausible stories. And I bet nobody can refute them definitively. It's all fuzzy judgment about. But so I thought morally, I'm here in Brazil. I'm not going to say I know. I'm saying this gives me a feeling of deja vu. I've seen this in America. And your experts who are telling you it's not a bubble, they're fallible.
Yes.
And I would worry. I just left it at that. I got into a lot of trouble for saying that in Brazilian newspapers. But that's the problem with bubbles, is that we don't have, as Lewis was saying, we don't have the models of fundamental valuation that can answer whether Brazil's home prices really ought to have doubled in 5 years. But I'm just skeptical. And
there are always a lot of it's different this time arguments. I mean, Lewis, we've had 5 years in which central banks generally have been trying to bolster asset markets,
Absolutely.
partly to revive the economy, but also to create a confidence effect by keeping equity prices up. Is that creating the fuel for more bubbles? And do you think there are bubbles already in existence?
Yes, I think it is creating the fuel for more, but I would ask a somewhat different question. Is it creating systemic risk? And there it's much less obvious to me as that applies to the core industrial countries. Emerging markets is kind of a different debate. But for example, the best broad indicator of systemic risk is an acceleration of credit growth. There's been a lot of research that was done before the crisis that was actually quite good at predicting it, that focused on this. IMF has expanded that work out to the world. If you look at those measures for the US now, they're at historic lows. So while you can look at particular parts of the market and see evidence of irrational exuberance. So mortgage finance is an interesting case. One of the things that people have cited is the very extensive risk-taking in, say, the mortgage REIT area, which is really all about how people are investing in conventional mortgage-backed securities. That's really all about mortgage interest rate risk. What's interesting is there is no bubble in mortgage credit risk in the United States. And so unlike the sort of very broad phenomenon of risk-taking that you saw before the crisis, it's very specific now. And I think that suggests to me that it is a function of what's going on in monetary policy, but it is not generating the kind of broader problems that ought to make you worry about systemic risk.
Thank you. I'm going to throw it open to the audience in a minute, but just one other point. Credit growth is seen as a vital economic indicator. You know, we worry that credit is falling in some economies. But isn't and it's the aim of central banks to try and stimulate it, but isn't the difficulty is that what we want is for credit growth to exist and for businesses to then go out and build factories and employ workers. But in practice, sometimes that credit growth gets diverted into buying properties, existing properties and other assets. And Professor Shiller, you know, how do you differentiate between those two?
This is partly a symptom of our dysfunctional, in the US, our dysfunctional Congress, that there should be more fiscal stimulus. When you rely only on monetary stimulus, you can't differentiate. So we should be doing infrastructure investing. Right now, the NIH budget has been declining. Our health budget has been declining in real terms. Why are we doing that now at this time when anything like that would stimulate the economy? So that's what we should be doing. I've been advocating also balanced budget stimulus. It's a political problem. Economics and politics are inseparable. But if we could do the right thing, we would have government raise taxes and raise infrastructure investment. And that would be better than, you're right, cutting interest rates and launching a housing boom.
Yeah, I just want to follow up on that point and just say, the problem is monetary policy is a blunt tool. You know, in some sense, you kind of drive things up together. I don't know of any way that you can have monetary accommodation that doesn't work through asset prices. And, you know, in some sense, that if you have to rely on monetary policy to generate stimulus, you're going to have those consequences. Now, there are other tools to contain the systemic side of things, the prudential risk side, but I very much agree with.
Okay, I want to throw it open for questions. We've had some sort of questions alluding to this in the last day or so. So if there's anybody who'd like to ask a question, raise your hand. There's a gentleman in the front here.
On the subject of bubbles, there's reference that's been made to where the credit growth is in the economy, also where the extreme price signal is in the economy. And I'm wondering if you could comment on the ostensibly risk-free asset, the long-term government bond, to the extent that we have generationally low real interest rates and influenced directly by the central bank expectations, and a generationally high stock of debt relative to gross national savings. Is there risk in the risk-free asset?
It's been described as return-free risk rather than risk-free return, isn't it? Lewis.
There's no question that, particularly if you went back to where we were before May, you could argue that the way risk was being priced in the Treasury market was extreme by any standard. Now, again, that was a more or less direct consequence of monetary policy. They were doing it because they felt they needed to. Since May, that pricing has adjusted materially, and I would argue it's less obvious that you have sort of an obvious problem there now than you had before. But again, that was the whole point of monetary policy.
Professor?
Yeah. We have been through a very anomalous time. Most notably, we've had negative rates on TIPS, on the inflation index bonds, I think it was out to 15 years.
In Britain, 50 years. You can
maybe got out 50 years in Britain. Isn't that amazing? That you would think that governments would view that as a huge opportunity now to borrow and do infrastructure investment with a negative required return. It's amazing. The other thing was that right after QE3 was launched, our mortgage rates hit an all-time low. It was like 3 1/3%. And that has a huge psychological impact. People think, it's pretty easy to conclude, that if we're at a record low, then the only way it's going is up. It's not going to go much further down. So it creates a sense of importance of timing. I have to buy now. And that seemed to be operative, and it helped launch this housing boom that we have right now.
Oh, there's a gentleman at the front here.
Thank you very much. Very insightful indeed. Just to move it to a slightly larger context, I want to come back to the question on bubbles. It would seem to me, among other conditions which are unique to the human condition, one is finiteness of knowledge, both in time. Mind is biodegradable, and therefore knowledge will exist before, so you have only history and present time to rely on. That bubbles are a fundamental nutrient to human progress and human growth, that it will keep repeating itself time and again, because if it did not, if it rooted itself in the rational, then it would stagnate, decay, and go out of existence, because the Kantian intuitive mathematics, where you intuit to a point in time, comes to my mind. So therefore, the focus should be, as Mr. Alexander pointed out, to areas where you can focus on, which is those that may seemingly be systemic. And to his point, your models will never, ever yield as to what is the fundamental truth, because that would be axiomatic, like defining a point. You cannot actually define a point. You start from an axiomatic explanation and then build your theory around it. So therefore, the focus should not be as much on detecting bubble and neutralizing bubbles as much as it would be on then what is the systemic component of it and looking at it. I'd be interested in your views on it.
So it's like Gordon Gekko. Bubbles are good. We got all that fiber optic cable. We got those condos in Miami.
I never liked Gordon Gekko, but maybe he had an element of truth. Well, there's a human impulse toward risk-taking and gambling, and it manifests itself in various ways, sometimes harmful and sometimes harmless. So we have lotteries now. They seem to be largely for lower income people. I mean, people in this room don't play the lottery, do they? But it kind of satisfies an impulse, and it does it in a relatively harmless way. You know, if you can make it once a day only. We also have slot machines, which are an invention of the private sector, and they are designed to capture as much money as they possibly can. It repeats very quickly. We don't like those. Those aren't. What we want is to design a system that allows people to indulge in their risk-taking spirit in a more constructive, less harmful way. So bubbles, yeah, you're right, are not bad. What's really bad is when people get destroyed by them. So, for example, a housing bubble, I don't see a lot of goodness in that. I would rather have a dot-com bubble, which seems to me relates. A dot-com bubble gets people thinking about new technology and where is it going, and that's probably healthy for a society. But a housing bubble, now especially a housing bubble with conventional mortgage finance that encourages people to put their whole life savings into one house. Young people at that stage in their life, they put everything into a house and they leverage it up 10 to 1. And then we saw what happens. Prices fall. We had 15 million households underwater in the U.S. And that launched this whole, so that wasn't a good bubble outcome. So what I argued in my book, New Financial Order, and my other book, Subprime Solution, is we have to recognize this human psychology and try to design institutions that protect people from the bad side of it, keep them focused on important things. So there should be new mortgage institutions, for example, that have some kind of risk management built in so we don't have a repeat of this crisis.
So, Lewis, technological changes need financing. Investors get over-optimistic, and they've got a lot more anxiety and uncertainty at that point. They can't possibly know what's going to happen. So that's a healthy process of bubbles being created, you could argue.
No. I very much agree with that, and that notion that aspect of them is positive. I think the trick is thinking about the system and when is it vulnerable to it. And that gets you to a sort of a slightly different set of issues around how do you measure systemic risk and how do you think about that problem. The biggest challenge in that area is, frankly, the pace of change of our economy. So if you think about US financial history, since 1900, we've had arguably 3 systemic crises. One in 1907, one in 1933, and one in 2008. If you just think of the pace of change of the financial system over that period, and think about how would we recognize these things building up, and to what degree was the experience in 1907 relevant versus the experience in 1933 versus 2008, it's a very complex problem. I think there are ways to do it. There are patterns you see in that history. A lot of it has to do with credit and leverage and those kinds of things. But it is a complicated challenge. And so I kind of agree with the way you framed it, but don't underestimate the inherent challenge in actually doing it.
If we have another question from the floor. Yes, the gentleman in the front here.
Thank you as well. This was a really insightful panel. Just a question on the fuel for bubbles. To what extent do you think that's a corollary of kind of trying to solve the wrong problem? If you look at monetary policy, it seems to me that the issue is not that it's not accommodative enough, but there's a fundamental transmission problem with corporates getting more efficient and preferring to distribute capital to shareholders as opposed to taking the leap of faith and investing in the real economy. Now, if we try to solve this problem with being more and more accommodative and keeping rates on the front end of the curve low for a very extended period of time, would that be kind of the fuel for future bubbles? And at what point do we realize it? And wouldn't it be too late, I guess? Thank you.
Thank you.
Let me give you one reaction to that. I come back to my point that monetary policy is a blunt tool. And to a certain extent, what the Federal Reserve in particular can do is limited by its legal authority. One of those legal authorities says it basically can only buy government debt and debt of entities that is guaranteed by governments. One could imagine a world where, say, for example, the Fed had the legal authority to buy a broader range of assets and could in some sense engage in more specific policies, like, for example, trying to encourage corporations to go out and do investments by structuring a financing mechanism for private corporations that was tied to their real investments. You can imagine a scenario like that. But you ask yourself, do you really want them to do it? I worked for the Federal Reserve for 10 years, and that's a scary thought to me. And so I think there's no way around this kind of problem that monetary policy is just a blunt instrument. And it can, sort of try and ramp up risk appetite. It can try and contract it. But to have it be more targeted in some ways, that gets tricky really fast.
Professor Shiller, did you want to talk to that?
Well, I just have very general thoughts about. I'm personally an admirer of Friedrich Hayek and John Maynard Keynes. And I think they were both polemicists. That's the way it works in academia. You become well known by taking an extreme position. But Hayek emphasized something very interesting to me, which didn't seem to be understood in the 40s when he wrote Road to Serfdom. And that was a time when there was great respect for science and technology, but the view was that it was known by, science was the province of professors at MIT or something like that. And Hayek was saying that the knowledge that's relevant to an economy is really dispersed over millions of people and can't be centralized. So that was kind of a revelation. His article in the AER, there was a special issue of the American Economic Review, which listed the top 20 articles in the entire history as voted by economists. And Hayek's article, prelude to his book, was there. So I think there was a recognition that we need a society of entrepreneurially oriented people. Not everyone, but it has to be an activity that many people have. And so that's a bubble economy, and it can be a bubble because you'll see false starts and you'll see...
On your question, sir, there's a good book by Andrew Smithers, which I wrote up in The Economist a couple of weeks ago, which argues that executives are incentivized to buy back their shares because it boosts their share option value, and not to indulge in capital expenditure because that causes them to miss their earnings target. So that's one reason why we're getting a problem. We have time for one more quick question if anybody has one. No? In that case, I am going to thank our panelists very much, and let's clap both of them again. Thank you.